Hello traders, welcome back to our Babypips course. For today we are still on course 10 of 11 undergraduate senior, and our course outline includes risk management, the number one cause of death of forex traders, position sizing, setting stop losses, which I have just considered, and today we're going to learn about scaling in and scaling out. So here we are, and under scaling in and scaling out, these are the questions or the subtopics we are going to learn. Scaling and scaling out of positions, how to scale out of positions, how to scale in positions, how to add to winning positions, and summary, scaling in and out of trades, right? So before we dive right into the very first one of saying, scaling in and out of positions, let us roll the intro. So here we are on scaling in and out of positions. Now, what does this actually mean? You now know how to set proper stop loss and calculate the correct position size. And it's now time for us to get a little creative in our trading. So for those trading multiple position sizes, you can get really flexible and creative on how you manage your risk by scaling in and out of your positions. Remember, for those trading multiple position sizes, okay, scaling in and out of your positions is a great way to go. So scaling in doesn't mean weighing yourself or something like that. Basically, scaling means adding or removing units from your original open position. So you take a trade, you want to add more to that positions, or you want to take out of that positions, right? So scaling can help you to adjust your overall risk, lock in profit, or maximize your potential profit, right? Now, what are the benefits of scaling? Please mind you, there are also wrong side to this. I mean, if you do not know how to use scaling very well, there are both good side of it, and also lots of drawbacks as well, okay? But we are going to learn the correct way so that we'll be very, very good with our account and not risk too much or even blow out your account. So what are the benefits of scaling? The biggest benefit is a psychological one. Scaling in and out of your position takes away the need to be absolutely perfect in your entry or exit. Is it this funny? Look. All right, so it's way very, very difficult to think you want to get a very or perfect entry. That's not going to happen because the market always goes up and down, right? So it is only logical for us to say, okay, we are entering this market at a good area or at a good price level, right? So you can enter your positions in bits and also in pieces around those areas, and you can also take your trade off at different levels to lock in profits. So it is much more easier that way and more psychological that way, because knowing that this whole area, price can bounce in this area. So if I enter the market at this place, right, then it's good, right? So if properly executed, with trailing stops, okay, scaling in and out of positions can help you to protect your profit just in case the price suddenly reverses. So finally, if you want to add more to your open position and the market continues to go your way, your bigger position will increase, and the amount you will make for every pip will also increase. Now, what are the drawbacks of scaling? Now, the drawbacks of scaling is that you increase your overall risk potential, okay? Forex traders are risk managers, right? Our number one goal in the market is to protect our capital, and if done incorrectly, scaling in can wipe out your account. So you have to be very, very careful when practicing scaling in, okay? Now, the second drawback is that when you remove portions of your open trades, you reduce your maximum potential profits, okay? And we don't want to do that, but it does happen. For instance, instead of making $100, you can end up making 50 or 25 just because you have earlier on locked in on some profit. Now, well, the market is fast and dynamic, and we know that, okay, it is not contained nor monopolized by any agency or anybody. So it can benefit you to reduce your risk and take off some, profit off the table, and just, be content at the end of it, or knowing that you still made profits. Okay, so this is basically what we have learning about scaling. So scaling in and scaling out, you know what it means, what it now means. Scaling in, you are adding to your position. Scaling out, you are taking some profit and closing in on your positions, and also protecting your account capital. So please click the like button, subscribe if you haven't, and you are doing this because it helps with the algorithm, so that YouTube can show this video to more persons. So as you do so, I will see you in the next lesson that says how to scale out of positions. So here we are on how to scale out of positions. As we have discussed earlier on, scaling out has benefits of reducing your risk by taking away your exposure, or much of your exposure in the market, whether you are winning or losing. Okay, either ways, okay, it reduces your risk. So when you use scaling out with trailing stops, okay, you have the more benefit of locking in more profits and also creating a nearly risk-free trade. Okay, so let's dive down into an example to see how scaling out. So let's consider this example, scaling out of Euro USD. So let's say you have an account balance with 10,000 US dollar, and you shorted 10,000 units of Euro USD at 1.3 thousand. You place your stop loss at 1.3100, and your profit target is 300 pips below your entry, 1.2700. With 10k units of Euro USD, a p value of this position is $1 per pip, and since your stop is 100 pips, that's a total risk of 100 US dollar. That's 1% of your account. Now a few days later, you observe that Euro USD has moved to 1.2900. That is 100 pips in favor of your open position. That is 1% margin gain, right? Now all of a sudden, the Fed releases a dovish comment that may weaken USD. Remember, you shorted Euro USD, which means you sold Euro, you buying US dollar. Now the Feds are releasing a comment that shows that this currency you are buying might get weak. So if it gets weak, what will happen? People are going to buy Euro and offload US dollar, right? So you say to yourself, okay, this may bring some sellers back into the market. I don't know if Euro USD will keep going down. I should lock in some profit. So you decide to lock in some profit. So you decide to close half of your position by buying 5k units of Euro USD at the exchange rate of 1.2900. Now this locks in $50 of profit to your account at 5k units of Euro USD at $1 per pip at 0.50 cents. Now you have closed in 100 pips. 100 pips multiplied by 0.50 cents. Now this leaves you with an open position of 5k units. Okay, so if the pair moves back higher and triggers your adjusted stop losses, okay, because once you close in $50 from your open position, right, you close in, you move your stop loss to your entry. If the price, the news affect the Euro USD, and you see Euro USD instead of shorting rising back up because the USD is weak, you get stopped out. And so once you get stopped out, what will happen is that you only locked in $50 from the trade, right? And you are out of the trade. Now if Euro USD ended up falling to 2700, and you have caught the 300 pip move with a 10k units of you, then your profit would be $300. That's if you didn't close out any of the units. Okay, so but in this case, you took out 5k units at 100 pip gain for $50, and then you close your remaining position 5k units gain for $150. So your overall profit and loss is 200 instead of 300. Why? You close in $50 earlier on, and then the trade went to your target and smashed your TP. Now, because your remaining loss size is 0.50 times the other units left, it will give you $200, including $150, including your $50 which you have closed out earlier on. That makes it a total of $200, and so that is how the trade ended. Okay, so look at the chart here. Let me open my pen so that I can draw. So you took a trade at this level here, 1.300, and look at the stop loss at the top, which is your stop loss is here. You enter your position here, you sold this market right now. So when you wanted to close, I'm not sure you know how to close in positions, right? But when you go to your MetaTrader and you say close, I think I should just show you. So you close in half of your positions, okay, at this level here at 5k units, and your trade smash take profit at this level. So you sold here, you bought here. By the time you are closing out a trade, it means you are buying at this level, okay? And when you let this consolidation ride and smash a take profit, you also buy at the end. Now the decision to take some of profits off the table is always up to you. You just have to weigh the pros and the cons, right? So in the example we looked at earlier on, excuse me, if you had followed that pattern, it would cost you nothing, and you would have lost. You would have made lots of money, and you'd have entered you have been riding a risk-free trade, okay? And 50% more profit of being added to that one, and then it will make you have a good night rest. So let's say you even closed at 50% and the market came to smash you out at your stop loss, okay? You'll not be worried because you made money at the end of the day, right? So yeah, now we want to consider how to scale into positions, and why it's good for you to scale into positions, and how you can do that correctly. Now, scaling into positions can give you, in fact, it can increase your maximum profit potential, right? And it also increase your risk as well the moment you are scaling into positions, okay? So if you do it correctly, fine, but if you do it wrongly, your accounts can get wiped out quickly and all your trades out, and before you know it, you just be looking at your computer screen wishing you had them scaled in, okay? So what separates the correct way from the incorrect way of scaling in and out is the profitability of your open position when you add, how much more you add, how you adjust your stops. All this makes a difference between the correct way and the incorrect way of scaling in and out of positions. Now, since traders are risk managers first, okay, that's our responsibility. Manage your risk, okay? So since traders are risk managers, it is important for all traders, okay, all traders, to be very careful with regards to scaling in, okay? Adding to positions isn't really a best way to go, okay? So have that at the back of your mind, and once you agree and you like this lesson, please smash the like button, okay? It helps with the YouTube algorithm to show this video to more people who love baby pips and want to go through this course in a very quick way, okay? So please smash the like button and subscribe if you haven't, and I'll see you in the next lesson that says how to scale in position. So here we are on how to scale in positions. Now in the previous lessons we learned how to scale out. So we have known that scaling out means closing out some of your positions. So let's say you took a position, you took a trade with a lot size of of 2.0, for instance, okay? Let's say you took a 2.0 lot size, 2.0, and you want to scale out. It just simply means go to your MetaTrader 4, click on a menu, where you want to close your account, okay? And in that place, before it says close, right, reduce your lot size from 2.0 to 1.0, you have closed half of this account. Okay, then move your stop loss to your entry, and you just let only 1.0 lot sizes to be running in the market. By so doing, you will be, in the trade risk-free, and by so doing you would have scaled out of your positions. So now scaling in means adding to your positions when your trade is going in your favor. Okay, now we're going to consider two examples. The first scenario will cover adding to your positions when your trade is going against you, adding more units or to a losing position. Okay, this is a tricky way anyway, but you will understand it right now. It can happen in this following way. Okay, before you do so, you must consider these rules. 1, a stop loss is necessary and must be followed. 2, the levels of positions must be pre-planned. The levels of position entry must be pre-planned before the trade was put on in the first place. Then 3, the position sizes must be calculated, like pre-calculated, and the risk, okay, of the combined positions is still within your risk comfort level. So once you fathom all these considerations into play, then you are good to go. So let's look at the trade example. Okay, so we see this chart, prices is coming down, and in this area price consolidated before price broke the support and created a lower high, lower low, failed to create a lower high, failed to create a lower low, give us an inverted head and shoulders pattern, and what do we see? Price pushing back up, okay, to retest this previous support, now turned resistance. Okay, so what is the best way to get into this market? Okay, with our tricky example. Now from the chart we have just considered, we see that the pair has moved lower from this area here of 1.300, and it has been consolidating in this area as well, right? It has been consolidating here, okay, between 1.2900 and 1.3000, and before breaking down to 1.2700. Okay, now so let's say you think the pair will return to the downside, but you're not confident of picking an exact turning point. Okay, so what do we do now? In a scenario like this, the very first thing you can do is short at the break of the support that is now turned resistance level at 1.2900, and that level would be somewhere here. Okay, short at this break here, somewhere there. Okay, now once that is done, okay, you can now place your stop loss higher above the resistance. Okay, and you could have potentially gotten in at a better price. Option 2 is this: you wait until the price reaches the top of the consolidation area, which is at 1.3000, which also happens to be psychologically significant level, potentially great resistance level. Okay, that's why it's called psychologically significant level. Okay, so once price reach that level, 1.3000, then you you get into the market with a much less risk. Okay, and you hope to ride the trade to the downside. So this is one level of 1.3000 we was just talking about at this area here. Okay, 1.3000, the psychologically significant level of resistance. Okay, now the third option is you can wait until the pair tests the potential resistance area, then moves back below 1.2900 into the downtrend before entry. That is to say, you wait for this price to rally back up to this level here, okay, and then when it's coming down below 1.2900, you have your entry in this area here. Okay, now that's for the third example or third option. Now the fourth option is this: why not enter both entries at 1.2900 and 1.3000? That's doable, right? Because you don't want to pinpoint the exact place, because it is only an area. This is only an area, right? So why not enter one position here at 1.2900? Let me change these colors so that we can have it better off seeing. Why not enter the position here, one entry here, or one entry here? But make sure these two positions, entry 1 and entry 2, make sure the units are the same within your risk comfort level. Okay, so even if price comes here and it's going against you, it also comes here, and you know this is a psychologically significant level of resistance. That price will definitely go down here. Okay, and your first entry and your second entry are within your risk comfort level. Why not do so? This is the area where price, okay, is definitely going to fluctuate up and down before it actually takes a U-turn. So that is what the fourth option says. Why not take two positions? Then what next you have to do once you have gotten the area you want to take your trades, and you've calculated your risk and your entry levels, the next thing is to determine your trade invalidation point, which is your stop loss. Where will this trade get to, and this trade setup is no longer valid, and that's where your stop loss comes in at 1.3100 level. Okay, so let's look at it again, see where the stop loss is in this chart. This is one entry, this is another second entry level, and look at where stop loss is, way above. Okay, your stop loss will be safe here, breathing, and you'll be very, very sure that the chances of prices going down is going to be heavily in your favor. So determine your entry levels. You can pick one at the resistance or support level. Support turned resistance level at 1.2900 and 1.3000. Then determine your position sizes. So let's say you have 5k account and you only want to risk 2%. That means you are comfortable risking $100. So 5,000 times 0.02 on this trade is very, very doable. So what about the trade setup? Okay, so let's say you are shorting 2,500 units of Euro USD at 1.2900. According to your peak calculator value, 2,500 units means $0.25, like that's 25 cents per pip. Okay, so every pip will from 1.3100, your stops will be placed there at 200 pips on this position, and if it hits your stop, that's $50 loss for you. And because it's a pip is valued at 0.25, and multiply it by 200 pips, that's your loss. So it will be a great trade if you short this unit and the trade goes in your favor. You made 200 pips, and that's a lot of profit margin for you. So look at the entry levels here. Entry level 1, entry level 2, you are shorting 5,000 units and you are shorting 2,500 units, and even if these two positions goes against you, you'll be hit TP at 100 USD. That will be great because it's still within your risk comfort level. And just in case you are wondering how the combination of the two trades creates a short position of 75,000 units of Euro USD with an average price of 1.2966 and a stop loss spread of 134 pips. If the market went down after both positions were triggered, then a 1-to-1 risk to reward ratio of $100 would be achieved if the market hit 1.2832, and that would be equivalent to 134 pips of your stops, and you'll be out of the market with $100 profit. Why? Because those two positions with a risk to reward ratio of 1:1 will give you your profit margin back. Okay, and you exit the market without any loss. Why? Because the bulk of your entry position was at 1.3000. Okay, not at 1.2900. It's at 1.3000. Okay, and from here to here and from here to here, it will give you just a 1-to-1 risk to reward ratio will give you your money back. So that is the end of scaling in. Right? Yeah, scaling into your positions, how you add into your positions. And for us to go to the next lesson, please smash the like button. It helps with the YouTube algorithm so that YouTube can show this video to more Baby Pips lovers. So smash the like button, subscribe if you haven't, and I'll see you in the next lesson that says how to add to winning positions. By the way, if there's any question you have, please drop your questions at the comments. Okay, so see you in the next lesson. So here we are on how to add to winning positions. So look at this guy. Do you know this man, DJ Khaled? You know that his song that says all I do is win, 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 no matter what. Oh my goodness, yeah, I remember that song. So how do you add to winning positions so that you always win? Now there are rules to safely add to winning positions. Now the very first rule is this: predetermine levels of entry for additional units. Calculate your risk with the additional units added. Trade stop loss to keep growing positions within comfortable risk parameters. Now trade example. So let's say we have Tom, the trend trader, who is closing watching Euro USD, and after a bit of consolidation, he thinks that the prices of Euro USD will continue to push higher, which leads him to plan to buy more units of some Euro USD, and at the price of 1.2700. So he first sees a recent consolidation level nearly traded close to 1.2650. So he decides to place his stop below that level at 1.2600. So Tom thinks that price will continue to go higher because there's a psychological resistance level of 1.3 thousand, right? So he's targeting his resistance level at 1.3 thousand, and that's where his maximum take profit is going to be. So what did Tom do? Tom decides to buy 10,000 units of Euro USD at 1.2700 and sets his initial stop to 1.2600, risking $100, and with a profit gain of $300 on site. Okay, so you are seeing the chart very well, but let me just draw. He entered the market here and he's targeting 300 pips, and at $300, risking $100 in total. And this is a 1-to-3 risk to reward ratio. When you are risking 1 with a goal of making 300, is called 1-to-3. Okay, when you are risking 1 with a goal of making 2, is called 1-to-2. So he is risking 100 with a goal of making 300. This is called 1-to-3 risk to reward ratio. So let's see how Tom can add to these positions gradually. Okay, so with a 100 pip at stake, 300 pip target, 1-to-3 risk to reward ratio, he's risking 2% of his total account, which is much, even though you can risk just 1%. Now let's see what Tom decides to do. Okay, so he has predetermined his initial stop loss and calculated all the units and everything in place. Now let's see how the market turn out. Now the market pushed over 100 pips in favor of Tom. Tom moved his stop loss from 1.2600 and moved it to break even, added another position at 1.2700. He has already locked in $100, right? So now let's see what happened after he locked in another position of 100k units. Okay, so he's risking another 100, and now let's see what happened. The next trade, Tom adds after adding to this one, prices continue to move higher, closing in on his take profit. Tom decides to add more units, more 10k units at 1.2900, and adjust stops on all positions to 1.2800. So after the very first positions was entered, he moved his profit stop loss to this level now, and he entered another position here. Okay, let's see if Tom is still in the right track, okay, as a trend trader. Now let's see, the market continued to push higher, and it's moved up, high up, and because he is safely added to his position, Tom turned out to hit take profit of $300 to his position, and an additional $300 because he kept moving his positions, adding to his positions 100, 200 and more, and he won a total of 600 instead of 300. 300. Okay, so that's how you add a position. So look, the very first position he entered was at this level, $300 risk. Okay, now this $300 pushed up, and Tom added another position to it, and he's now plus $200. Now Tom added another third position to again, plus another $100. So 2 plus 1 is 3, plus his initial $300. That made it $600 at take profit here. So that is the good news of adding to positions. Okay, so with this example that you have seen, and with this technique, you know, scaling in or adding to more positions, okay, is good, especially when you are trading a trending market. So please endeavor to ensure, if you are going to apply this trick, endeavor to make sure you are in a trending market, because you are adding to more positions. Okay, things can happen like really crazy. Okay, price can go against you if you are not in a trending market, and it can smash your stop loss, take you out of the market, and also, if possible, wipe out your account. Be very careful though. Do not enter more positions in a range bound market or periods of liquidity. It can leave you with frequent stop out many times. So this eats up into your free margin. Money that you can use to take other better trades have been cut up or stuck up or even wiped out from your trading account. This is not good at all for you. So take these considerations into heart when you are deciding to either to scale into or add into more of your winning positions. Okay, so this brings us to the end of this next lesson. If you have not clicked the like button yet, please do so. Okay, it helps with the YouTube algorithm to show this video to other people who need to go through this course in a quick manner as well. So I'll see you in the next lesson that says summary, scaling in and out of trade. So here we are on summary, scaling in and out of trades. There are lots of things we just have to remind ourselves over. Okay, so let's see what we have, you know, learned so far. Now the very first thing we want to remember is this: always use stops. Okay, only add to losing positions if the risk of your combined positions is within your risk comfort level. If you add to winning positions, always trail your stop to control the added risk. A bigger position size brings bigger, you know, risk potential as well. Okay, calculate the correct position size and where you will add or remove from your position before you even enter the trade. Scaling into trades without scaling into winning trades is best applied to trending market. Yes, now scaling out works well in range bound market. That's where you want to scale out. Okay, so here is the board. Scaling can help you to adjust your overall risk, lock in profit, or maximize your profit potential. Always follow the rules, and sooner or later you will cash that one move that will bank you some serious money. If you want a real life example of your scaling into position paid off, check this long EJ setup. That's Cyclopip 2. Let me just look at it. I usually do this. So oh my goodness, Cyclopip is a crazy trader. Oh my goodness. Wow. Look at that. First position board. Second position board. My goodness. Third position board. Fourth board up to stop out. Total pin count is 850 pips. Oh my goodness. That's some heck of some pips. Wow. Anyways guys, so that brings us to the end of this lesson, scaling in and out. Please smash the like button, subscribe if you haven't, and until next time, see you in the next lesson that says relations with currency.